Dear students, welcome to Swayam Shikshaa. This is Ram Sudhir, and I'm very happy to see your comments, and I've decided to continue this series. And this is the second part of the banking regulation. And this we will call it as the theme 4, which is the banking regulation. And in that, there's a second part because it's a huge area. So first of all, we'll try to see a few questions which were asked earlier. Now, there was this question about inter-creditor agreement signed by Indian banks and financial institutions recently. So one observation, generally students get into depth of few technical areas which is not required for exam. You should know what it is, that should be sufficient. In economics, generally, you should know what it is and why it has been asked. Like, there is a logic behind asking a particular question. Okay, so if you see, in 2019, there was a question on Bank Boards Bureau. Again in 2022, there is a question on Banks Board Bureau. So that means if we would have read Bank Board Bureau properly, then probably 2019, if you had read it properly in 2022, there's no chance of making a mistake. So generally what students do is they solve previous questions, but you just go to the answer and leave the options. No, you have to do the research on the options. And once we do research on the options, then definitely I will tell you, you are going to get 6 to 7 questions more than the competitor. Now, this is a very important aspect. Researching, what kind of research? Research on the options. There are different options. Can I get deeper into those options? Can I see any other question that can come from that particular area? This becomes very important. It's a small suggestion to students. Now, let's see this agreement here. Okay, so let's see the questions first. What was the purpose of inter-creditor agreement signed by the Indian banks and financial institutions recently? So that time this was in news and therefore this question was asked. Okay, and then in 19, again there was this question, chairman of public sector banks are selected by. Okay, so chairman of public sector banks are selected by. Now selected by, not appointed by. So selection is different from appointment. Okay, so selection is done by Banks Board Bureau. Okay, so Banks Board Bureau. So now you have to check what is a Banks Board Bureau, what is the purpose, which committee has, based on which committee Banks Board Bureau has been established. For example, PJ Nayak committee. Okay, so this becomes very important. Rather than just reading, okay, this is the question and this is the answer. So that will not work. So when I say appointment and when I say selection. So appointment is basically done by the Department of Financial Services. Okay, Ministry of Finance. But appointment is done by Banks Board Bureau. So you have to see, okay, this is selection, this is appointment. Okay, then again, if we see in 2022, with reference to Banks Board Bureau, which of the following statements are correct? Now, there was a question again on Banks Board Bureau. That means if some research has already been done on Banks Board Bureau very properly, this will not go wrong. Now, credit rating agencies. So, whenever there's detailed discussion on credit rating agencies, like this rated this way, that way, so how companies are rated. So, generally we should get into credit rating agency. What is a credit rating agency? What is its purpose? Who regulates a credit rating agency in India? Okay, so SEBI regulates it. So, some basic facts about it will be sufficient for us to crack questions in the exam. Okay, so that becomes very important. Okay, now see. Let's try to go to this question and related areas. Now, inter-creditor agreement signed. Now, it's not about inter-creditor agreement, but there were questions like, there was a question on Project Shashakt. Okay, so it is all related to handling NPS. It was in news. So in this Project Shashakt only, it is clearly given. Okay, so 50 to 500 crores or more than 50 crores basically. It is handled by inter-creditor agreements. So one understanding here is, from 2011 to 2016, NPAs have increased, non-performing assets. Types of NPAs, please refer to the previous video. Okay, so government had to do something. Government as well as RBI have to do something related to these. So there can be some questions. They have already asked strategic debt restructuring was done by RBI in 2015-16. Most of the reforms came up during this point of time. Strategic debt restructuring. Or RBI came up with schemes like S4A, Scheme for Sustainable Structuring of Stressed Assets. So it is related to banking. Specifically, it is related to handling NPAs. So these are all previous year. Then, based on SARFAESI Act 2002-3, there was this private ARCs, asset reconstruction companies. Okay, so the purpose of an ARC is to recover bad loans. Recover bad loans. You'll buy the bad loan from the bank and you'll try to recover it. It was a failure in the sense they're not too successful. Private ARCs were not too successful. So government was talking about Public Asset Reconstruction Agency, which is called as PARA. Okay, PARA. And bad bank concept. Bad bank is also one such bank which will mainly recover bad loans, and specifically from the public sector banks. Public sector bank. When I say bad loan, I'm talking about NPAs. NPAs. Like this, there were many reforms, 2011 to 16. And Modi ji in 2016 has come up with IBC, Insolvency and Bankruptcy Code, and several amendments in 2018, again 2021. But the base of IBC should be clear. Okay. And then to handle or to increase the strength of the banks, we already touched Basel norms, but another important area is the Basel 3 specifically. So we solved a previous question also, the previous video, and I was talking about Basel 1, Basel 2, capital adequacy ratios, etc., tier 1 capital, tier 2 capital. So please refer, okay, the previous video. Now here, when we talk about, of course, strategic debt restructuring, there may not be a direct question on this, but you should know it is related to banking, it is related to handling NPAs. So whether it is asset reconstruction companies, strategic debt restructuring, S4A, similarly Project Shashakt, intercreditor agreements, etc. All that was not so successful, and therefore you have IBCs, etc. Okay, so Basel 3 guidelines, India wanted to implement it completely by 2019, and Basel 3 was an advanced format of Basel 2 because in spite of there being Basel 2, there was subprime crisis in US. So that means these guidelines were not sufficient enough. So one aspect is identifying the big banks like the Lehman Brothers, which have collapsed, which are called as GSIB, globally systematically important banks. Now what we should understand is, in India, our banks are not so big. Our banks are, you can't categorize them as GSIB. So we started categorizing them as DSIB, domestically systematically important banks. So regulation should be stronger because bigger banks like SBI, if they collapse, impact will be more. Now when we talk about capital, so the Basel was also Basel 1, refer Basel 1 and Basel 2 in the previous video. Basel 3, basically, when it was talking about capital adequacy ratio, it was specific. It said, yes, 8% is sufficient, like the Basel 1 and Basel 2. Of course, RBI was saying 9. Okay, but other than that, it also came up with capital conservation buffer. Capital conservation buffer. Okay, and along with capital conservation buffer, it came up with counter-cyclical buffer. Counter-cyclical buffer. Now, these are basically additional buffers. Okay, so which were not there in Basel 2, which are only there visible in the Basel 3 guidelines. That is important. So now here, capital conservation buffer, you're keeping an additional capital of another 2.5%. Okay, so total capital to risk-weighted asset. What is a risk-weighted asset? What is the total capital? What is tier 1? What is tier 2? Previous video. Now here, capital additional buffer you have to keep of 2.5% according to Basel 3. Okay, then you have a counter-cyclical buffer. Counter-cyclical means the purpose of this buffer is basically whenever the economy is doing well. Okay, you want banks to maintain higher buffer, or you want banks to maintain higher increased capital, which can be used by the banks at this point when the economy is not doing well. So no bank will be interested in pushing or giving more loans during COVID pandemic, during this. But you have to revive this cycle, have to counter the cycles of the economy. So banks should be in a position to give better loans. Bank can give better loans when it has enough capital adequacy ratio. So enough capital adequacy ratio means during this point, if you make the bank to maintain more capital, this can be used by the bank to give better loans during the bad period. So This counter cyclical is nothing but you're demotivating banks to give from giving excess loans during the good period, which can be capitalized on giving better loans during the bad period. This is called as what? Counter cyclical. There is a range. It is a range 0 to 2.5%. Okay. So along with this, there is liquidity coverage ratio and net stable funding ratios, NSFR. This is also not there in the Basel 1 and 2. It is only there in Basel 3. So when I say liquidity coverage means you are trying to handle the short-term liquid funds for the bank. Okay. So that is basically in a 30-day period, what is the average cash transaction? That means how much ever the depositors can remove money. Let's say in a month on an average, depositors can remove 100 crores. Okay, that means at least 100 crore should be maintained in the form of liquid assets to avoid sudden bank run. Suddenly everybody is removing. There is a risk. So to handle sudden bank run for a short-term period, for a 30-day period, you want to avoid bank run. You have to maintain 30-day requirement of the bank in the form of liquid assets. That is what is liquidity coverage ratio. NSFR is long-term. Net stable funding ratio is long-term funding for a period of 1 year. Does a bank has a continuous source of long-term funding for a period of 1 year and above? So why? Because banks are not capable of giving long-term loans. Banks cannot give because banks have a challenge of asset liability mismatch. We deposit money. Liabilities are only for a short-term period. But if banks are giving loans for a long-term period, there's a gap. This is called as asset liability mismatch. So therefore, do the banks have enough net stable funding ratio, long-term source of funding for the bank for a period of more than 1 year? So this should be 100%. So this is something like these terms are also related to Basel 3, very important. Then Basel 3 also talks about leverage ratios. Leverage. Now leverage ratio will talk about the total capital to the consolidated assets. Consolidated, not the risk-weighted assets, consolidated assets. Total loans, I'm putting in the denominator, and the total capital which the bank is having. So what is tier 1, tier 2? You can refer in the previous video. But total capital to the consolidated asset should be at least 3%. Okay. Now if we see, RBI's logic is what? 9%. Capital adequacy ratio, 2.5%. Capital conservation buffer, max again, you have a counter-cyclical buffer of 2.5. It means it overall comes down to 14 max, okay, according to RBI. Okay, and large exposure framework, which I've discussed in the previous video. So large exposure framework is also important for exam. Okay, so because there is a risk associated, Adani is in news, so therefore that becomes important. So this leverage ratio, etc., should be 3%. Okay, so that also is there as part of the Basel guidelines. So Basel 3 guidelines very specifically. So Basel 3 we talk about GSIB, all this becomes important. So this is not there in the Basel 1 and Basel 2. Okay. Now what we should understand is, so now the thing is, when we talk about the regulatory part, okay, so Basel 3 guidelines India is following, and in fact Basel has mentioned that RBI, you're doing a better job, in fact, with respect to large exposure framework, etc. This is what Basel has appreciated RBI in terms of our guidelines with respect to large exposure framework, etc. Okay. Now, what kind of questions can come up? Specifically, technical questions will not be asked. So in Basel 3, if they're asking for long term, you should know NSFR. For short term, we should know LCR. Leverage ratio means what you should know. Minimum tier 1 capital should be at least 6%. According to the Basel 3 guidelines. Okay, overall it crosses about 10, but minimum is 6. Okay, so like this basic fundamentals, if we know, our job will be easy in the exam hall. Okay, and then comes up IBC, Insolvency and Bankruptcy Code, which has come up with 2016. So there can be a question on IBC. Of course, here discussing IBC becomes a big challenge, okay, in detail. But what we should understand is, basic way of understanding is, some changes. So there is an insolvent, okay, and there is somebody who cannot pay back the loan, and all there is a legal procedure to recover money. In India, the biggest challenge is whenever a company is not doing well, you push the company down further. There is less scope for revival in India. Revival nobody is doing. Okay, so unlike countries like UK, that is why doing business in India is very difficult. When a company is collapsing, you push it even more down. But the problem is, let's say there is Jet Airways. Okay, there is Jet Airways. Jet Airways is there, and we have something like SBI. Now SBI has given some loan to Jet Airways. Let's say some 1,000 crores. Now tomorrow Jet Airways, now today Jet Airways is not there. Then you have to either revive Jet Airways, or you have to at least liquidate Jet Airways in a time-bound manner. Now very important is time-bound manner. Now this time-bound manner in India, it is not there, years together. Now the question comes up, what is the challenge? Okay, so whenever there is such a case, here SBI is the creditor, okay, and Jet Airways is the debtor. Okay, now there is a case. Now they can go to the IBC procedure. They can follow the IBC procedure. So in IBC, we have an adjudicating authority. So this is adjudicating authorities are those authorities which take up the cases. So in IBC, we have two types of adjudicating authorities. One is we have the NCLT, and another one is the DRT, National Company Law Tribunal, okay, and Debt Recovery Tribunal. So now the case, this is a corporate company. So corporate cases will go to NCLT, and individual and partnership firms will go to DRT, Debt Recovery Tribunal. So once they accept the case, now who can take the case to NCLT? So either it can be the creditor who can take the case, either it can be the debtor who can take the case to NCLT, or it can be operational creditor. Now the new changes. Operational creditor can also take up the case and go to NCLT. Now when I say operational creditor, SBI is a financial creditor. So who is a financial creditor? Financial creditor is somebody who keeps some asset or mortgage and gives loan. Operational creditor is somebody is unsecured. For example, let's say I got an offer from Jet Airways, and the offer is to supply food in Jet Airways, or I can say catering services in Jet Airways. And I'm supplying food or biryani to Jet Airways on a regular basis. But I was not paid. I thought it's a very big contract. Maybe I'll get paid after 6 months. I was continuously doing catering services in the Jet Airways because the contract is big. If not me, somebody. So therefore, Jet Airways I was supplying. And after 6 months, I got to know there is no Jet Airways. I'm down. I'm gone. Now, what did I do? I have supplied some food. I have supplied some, I have rendered some service without taking money. I am an operational creditor. On credit, I have supplied. Now they have to take care of me. So earlier operational creditors were neglected in the earlier IBC. They were the last to be taken care of after the whole procedure is over. But now operational creditor also can take up the case and go to the adjudicating authority. So now the question is, they wanted a time-bound mechanism. So one is the adjudicating authority. Then you have insolvency professionals. Every Tom, Dick and Harry cannot handle the insolvency procedure. Why? Because you need experience. So these insolvency professionals are trained professionals who are trained, and they operate under the insolvency professional agency, which gives the ethical code of conduct or code of conduct rules, which the insolvency professionals will follow. And you also have information utility centers. All the database is there with them, information utility center. And the database related to the debt or the asset, etc. All that will be supplied by the information utility centers. And you also have Insolvency and Bankruptcy Board of India. So this is a regulatory body which regulates the whole mechanism. So like this, you have different entities. But first what happens is, the case goes to the adjudicating authority. Once the adjudicating authority accepts it, the adjudicating authority will appoint the insolvency professional. Now insolvency professional will design a mechanism, and the mechanism is something like you have to resolve the case. That is, you have to revive it, Okay, you will come up with a revival plan. Okay, it should be accepted by the committee of creditors. So committee of creditors, mainly the creditors who have given loans, the committee of creditors have to accept it. Once a plan is accepted, within 180 days, plus another 90, 270. Earlier it is 270, now it is extended to 330 days. So within 330 days, you have to solve, you have to liquidate the company or you revive the company, whatever it is, once it is accepted. If it is not accepted, no issue. It is accepted, then it should be over within a span of 330 days. Now all that is basically in India, now till the recent past it was okay. But today what we observe is there is a challenge. Average if you take, it is 770 days it is taking, unlike 330 days. For startups it is different. For startup anyhow 90 days plus another 45 days you have to solve it. But a regular company, it was earlier 180 plus 90, 270 days. Now it is 330. Now, but what data shows is it's taking more than 700 days, 750, 770 days. So this shows that there is this time-bound procedure also, there's a challenge. Second is acceptance by NCLT. NCLT, is it accepting properly? Okay, so is it, how many cases are really accepted by NCLT? If NCLT is not accepting, then what is the point of having IBC? Okay. Then comes up another question that can be asked in the exam related to this, can be haircuts. Okay, what is this haircut? Haircut is something like the creditor accepting to give away major chunk of debt. Okay, so the creditor is given, so that means somebody has given 100 crore loan, he is ready to give away 95% of the loan. Okay, so that means there is a haircut. Haircuts have increased. So the creditor is losing, that is creditor who has given loan, okay, he is ready to accept haircuts. Okay, so he's ready to accept that he's not going to recover 100% debt. Forget about 100. More, there are companies which were given leeway of 95%. For example, Videocon Group, 95% it was unable to pay. It was okay. They have accepted it, let that company not pay. So these are called as haircuts. Now it is a danger. Haircut is a danger, time-bound procedure is a danger, etc. So this is a technical area. So terms should be clear. Once terms are clear, any small question comes up in exam, we can answer it. Now let's go to some questions here. So inter-creditor agreement. Now I don't think they will ask this S4A or these are news in 2016, 17, 18. Okay, as we have mentioned. So this is basically the aim at faster resolution of stressed assets of rupees 50 crore which are under consortium lending. So this is what was the purpose. Okay, so that should be clear. Okay. One second. Okay, so now let's try to understand few more questions. Regulatory questions were asked. Now this was the question, the chairman of public sector banks are selected by. Now this was asked in 2019 and we should know it as Banks Board Bureau. So Banks Board Bureau is basically, it was formed based on PJ Nayak committee recommendations. And Banks Board Bureau is, it is selecting, not appointing, as I've mentioned earlier. That is very important. Okay. Another important aspect is the head of Banks Board Bureau is not RBI governor. Okay. So if you try to understand Banks Board Bureau, there is a chairman and 3 ex officio members. So these 3 ex officio members are from, we have from the deputy governor of RBI is there. There is a secretary to the Department of Public Enterprises, and there's also a secretary to Department of Financial Services. So you have 3 ex officio chairmen, and we also have 3 experts. Okay, and this particular entity, it not only selects for banks but also for insurance companies. So this is something which we should understand. We have to dig a little deeper into how Banks Board Bureau is going to function. Okay, so directors of government regulated insurance companies also, government handled insurance companies are also appointed by, basically, not appointed, selected by basically the Banks Board Bureau. So this is what we should understand, very specific. So these are again related to regulation. Okay, so with reference to Banks Board Bureau, again 2022, which of the following statements are correct? So the governor of RBI is the chairman? No. It has a chairman and 3 ex officio members plus 3 experts. Okay. Banks Board Bureau recommends for the selection of heads of public sector bank. Now this was already there, yes. It is true. 19 question. Banks Board Bureau helps the public sector banks in developing strategies and capital raising plans. Yes. Okay, so 2 and 3. Okay, so once the concept is clear, once the research is clear, there should not be any problem. Now, this is about credit rating agencies. So we generally read about credit rating agencies, but we don't do some research on credit rating agencies. So when I say a credit rating agency like this, a credit rating agency are regulated by SEBI, not RBI. Very important. Okay, so who is regulating a credit rating agency becomes very important. The rating agency is popularly known as ICRA, is a public limited company. Yes. So this is very important. This is a public limited company, and Brickwork Ratings is also an Indian credit rating agency. Both are Indian credit rating agencies only. So if we talk about this particular Indian credit rating agency, that is the Brickwork Rating, it is set up by bankers, group of bankers basically. Okay. So here the first statement is wrong, but the second and the third statements are right. So read about regulation, very important area, read very properly, and check the Basel guidelines. Okay, and also related to NPAs, check our previous videos, previous themes, etc. I hope my explanation has added a value for your prelims preparation. Please do share the video to all the serious aspirants, because here there should be some motivation, inner motivation for me also. And please do comment if you like it, if you are able to understand. This will make me even more motivated to contribute more. And we have to crack this prelims, and I will definitely contribute to your success. Signing off, thank you.